Hey everyone, welcome back to Corporate Decoder, the place where we dissect the money-making secrets of big business. And today we are diving into Utz Brands Inc.'s latest annual report. Get ready because this filing is packed with enough numbers to make your head spin. But we're going to find the hidden stories and figure out if Utz is truly snacking on success or if they're in a bit of a pickle. And before we crunch these numbers, remember to hit that subscribe button and join our Discord community, linked in the description below for even more insider insights. Let's kick things off with a look at Utz's financial health. As of the end of 2025, their total assets were just shy of $2.8 billion. That is a lot of snacks, but also a lot of stuff. What is interesting is how their liabilities stack up against that. Total liabilities are close to $1.5 billion. Meaning they owe a substantial amount of money. Now, a company owing money is normal, especially for growth, but the question is how much of that is manageable. Looking at their sales, Utz brought in about $1.44 billion in 2025, a slight increase from the previous year. That sounds good, but what is behind that number? They're saying this rise is thanks to more sales volume and product mix, which is usually a good sign. However, they also saw a drop in prices which eats into profits. This is where things get a little less crunchy. While sales went up a bit, their gross profit actually went down. That means the cost of making their snacks went up faster than they could sell them at a premium. Their gross profit margin, which shows how much they make from each dollar of sales after paying for materials, slipped to 24.9%. This suggests that rising costs for ingredients, labor, and getting those snacks to stores are really biting into their bottom line. And then Therese selling, general, and administrative expenses, or SG&A. This jumped up by over 12%. They're saying this is to support their growth and expansion into new areas. That makes sense, but when your gross profit is shrinking and your other costs are shooting up, it starts to paint a picture of a company trying hard to grow but facing some serious headwinds. But wait, there is a big number here that needs explaining. A $44 million gain on the sale of a business in 2024. This helped their other income line look a lot better that year. They sold off some brands and facilities, which gave them a nice cash injection. This kind of move can be smart to streamline operations. But it also means those businesses are no longer part of Utz, and we need to see if the remaining business can keep up the momentum. From a cash flow perspective, things look okay. They generated over $112 million from their day-to-day operations in 2025. That's an increase and generally a positive sign that the core business is still bringing in cash. They mention improving how they manage payments with customers and suppliers, which is a smart financial move to keep cash flowing. Now, where is all that cash going? A big chunk, nearly $103 million, went into buying new property and equipment. This shows they are investing in their future, perhaps building more factories or upgrading existing ones. This is a good sign if it leads to more efficiency and better products down the line. Looking at investing activities overall, they had a significant outflow of cash in 2025, much higher than the previous year. This was partly due to buying equipment, but also because the year before they had a large inflow from selling off those business assets we talked about. So, while they are investing, it's important to remember that the prior year's number was boosted by a one-time sale. On the financing side, 2025 looks much better than 2024. They actually had cash coming in from financing activities compared to a large outflow the year before. They did some borrowing and refinancing, which is typical. They specifically mentioned refinancing their term Loan B in January 2025, which reduced their interest rates. Lowering interest costs is always a win, freeing up more cash. Let's circle back to the balance sheet. Their intangible assets like brand names and customer relationships are huge, worth almost $1 billion. Goodwill, which is basically the premium they paid for past acquisitions, is also massive at over $865 million. When a company has so much in goodwill and intangibles, it's crucial that their underlying business performs well. If the brands they bought or built don't deliver as expected, they could face huge write-downs, which would really hurt their profits. Now, for the stuff that keeps corporate strategists up at night, Utz lists a ton of risks, and frankly, some of them are pretty serious. They operate in a super competitive snack market with big players like PepsiCo. They're worried about changing consumer tastes, and if they can't come up with new, exciting products fast enough, they could fall behind. To raise the risk of losing key customers. Think about it, if one of their biggest grocery store partners decides to carry less of Utz products, that's a significant hit to sales. And this point about our reliance on key customers is huge. They're saying that if they lose even one big customer, or if those customers demand lower prices and more promotions, it could really hurt their profitability. They operate in an industry where shelf space is gold, and they depend on those big retailers to stock their products. With retailers also consolidating, their bargaining power with those stores might be limited. Another big concern is demand. If consumers suddenly decide they want healthier snacks, or if a new trend blows up that Utz isn't part of, their sales could suffer. They're betting heavily on innovation, but as we see with their shrinking gross profit, innovating and producing delicious snacks while keeping costs down is a constant battle. Then there is the reputation wildcard. Any issue with product quality, safety, or even their environmental practices could damage their brand image and lead to lost sales. In today's world, with social media, bad news travels like wildfire and can really impact a company fast. Finally, let's talk about their debt. They have significant debt and their loan agreements come with rules or covenants that can restrict what they can do. If they break one of these rules, it could lead to even more financial trouble. This is a constant tightrope walk for companies with a lot of debt. Okay, so what is the story here? Utz Brands is a company with a long history and some iconic brands trying to navigate a tough snack industry. They are investing heavily in growth, both through acquisitions and by expanding into new markets. They've managed to keep their sales relatively stable and are even seeing some organic growth in their core areas, which is commendable. However, the numbers show some real pressure. Their gross profit is shrinking while their costs, especially for selling and general expenses, are going up significantly. This is a classic sign that the cost of doing business is increasing and they're struggling to pass those costs on to consumers without hurting sales volume. The fact that their sales are up slightly, but their gross profit is down, is a red flag. It means they are selling more units perhaps, but at a lower margin per unit, or their production costs per unit have gone way up. The company also has a lot of intangible assets and goodwill, meaning they've spent a lot of money acquiring other businesses. For this to pay off, those acquired businesses need to be successful and profitable, and the integration needs to go smoothly. If not, they could face big write-downs. On the positive side, their cash flow from operations is healthy, and they've managed to refinance some of their debt to get better interest rates, which is smart financial management. They are making strategic moves like selling off less profitable parts of the business and investing in new products. But the risks they highlight are real. Competition is fierce. Consumer preferences can change on a dime, and their reliance on a few big customers could be a major vulnerability. They are also dealing with rising inflation and supply chain challenges, which are hitting many companies right now. My take is that Utz is in a fight. They have a strong base in their core markets and some popular brands, but they need to find a way to control their costs more effectively, or pass them on without losing sales. Their growth strategy is sound in theory, but executing it in this environment is proving to be a challenge. The big investment in property and equipment might pay off in the long run by lowering costs, but it is a gamble. They need to watch their debt closely and make sure their acquisitions are truly adding value and not just becoming liabilities. It's a delicate balance and they need to nail it to truly thrive. What is your take on this juicy snack filing? Can Utz crunch their way to future success, or are they going to get a bit stale? Let me know your thoughts in the comments below. If you found this breakdown valuable, give this video a thumbs up and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community linked in the description for more discussions and to stay ahead of the curve. Thanks for watching, and we'll see you in the next one.